Welcome to the deep dive. Today we're taking a close look at some pretty big news involving Warren Buffett and, well, the future of Berkshire Hathaway.
That's right. We're digging into an analysis from The Motley Fool, actually published just this Saturday, May 4th, 2025.
Okay.
The title kind of says it all. Warren Buffett to step down as Berkshire Hathaway's CEO. 7 reasons the ultimate Buffett stock is still a no-brainer buy.
Right. So the big news is Buffett stepping down as CEO at the end of 2025. That definitely feels like, the end of an era. But what we want to figure out here is why the Motley Fool thinks Berkshire Hathaway stock, that's BRKB, is still such a strong buy for the long term, even with this huge change coming up.
Exactly. The idea for this deep dive is really to get past the headline and understand the core reasons the article lays out. What should you, as a long-term investor, really be thinking about as Berkshire enters this, next phase?
Yeah, the big question is, okay, Buffett's moving out of the CEO chair. What actually matters for the company's future and, for your potential returns?
So the article kicks off by mentioning the announcement itself. Buffett dropped the news at the annual shareholder meeting.
Right, on Saturday.
Yeah. And apparently, he'd only told his kids, Howard and Susie, who were on the board, just beforehand.
Interesting. Though it does follow that February shareholder letter where he kind of hinted this was coming, didn't he?
He did, yeah.
Yeah.
Wasn't a total shock, maybe, but still. I mean, the man turned 94 last August. His legacy is just immense.
Absolutely.
So even with the hint in February, the actual announcement, it still makes waves and raises questions about what happens next.
Totally. But the Motley Fool seems pretty confident. They actually give, 7 specific reasons?
7 reasons, yeah. 7 arguments for why they think Berkshire is still a no-brainer buy.
Okay, let's dive into those. Reason number 1, an incredibly diversified business. What's the thinking there?
Well, this is sort of fundamental to Berkshire, isn't it? The article points out they run something like over 60 subsidiary companies.
Wow, 60.
Yeah, and across tons of different sectors. Consumer stuff, finance, utilities, you name it. Plus, they've got big stakes in over 40 other public companies.
Like Apple, Amex, Coke.
Exactly. Coca-Cola, Chevron, Amazon, the list goes on.
The article even compares it to holding an S&P 500 index fund, which is funny because that's something Buffett himself has often recommended for people.
Right. It's like Berkshire itself is that kind of diversification built in. It's not just about having lots of businesses. It's about how they, balance each other out.
So less risk maybe if one sector takes a hit.
That's the idea. Historically, that breadth has helped smooth things out during downturns compared to, say, a company focused just on one thing. You can see how different parts of Berkshire perform during past recessions, for example. That base provides resilience.
Okay, that makes sense. Reason number 2 they give is that it's a stable business. How's that different from diversification?
Well, they're related, but this focuses more on the nature of some key Berkshire operations. Think insurance and energy, specifically.
Ah, right. Things people always need.
Exactly. Demand tends to be pretty steady there, which means reliable cash flow coming into the company.
They use that Buffett quote about Coca-Cola, how a ham sandwich could run it.
Yeah, implying some businesses are just inherently solid. The article suggests that applies broadly to Berkshire.
So for someone listening, why is that steady cash flow so important? What does it let them do?
Well, predictable cash flow is like gold for a company like Berkshire. It gives them money they can count on to, reinvest in the businesses they already own, maybe look for new companies to buy when prices look good.
Or potentially return cash to shareholders eventually.
Or potentially return cash, yeah, through buybacks or maybe even dividends down the line, though Buffett's always preferred reinvesting for growth.
Okay, number 3. This is probably the one everyone's thinking about, a solid succession plan.
Yeah, absolutely critical. The article names Greg Abel as the intended successor for CEO.
He's already a big deal there, right? Runs the energy side.
He does. Chairman and CEO of Berkshire Hathaway Energy, and he's also vice chair for all the non-insurance operations. He's been deeply involved for quite a while.
And Buffett's given him a pretty big thumbs up, hasn't he? Said something like, Greg can do better at many things.
He did say that. That's a huge vote of confidence. It tells you this isn't some last-minute scramble.
Right.
Abel's been groomed for this, you could say.
Yeah.
It suggests a deliberate, thought-out transition designed to reassure investors that things are in good hands.
Okay, reassurance makes sense. Then reason 4 is an enduring investment philosophy. The idea being the Buffett way sticks around even if Buffett himself isn't CEO.
That's the argument. The Motley Fool stresses that Abel will oversee the investments, and they point to Buffett comparing Abel to Charlie Munger in that recent letter.
Ah, comparing him to Munger, how so?
Specifically about acting decisively on good opportunities. Buffett seemed to really value that quality in Munger, and he sees it in Abel too.
So suggesting that same kind of value-focused, opportunistic investing will continue?
That's the implication.
But, I mean, can anyone really replicate Buffett exactly? Every leader is different.
That's true. No one's a clone. But Abel's been steeped in the Berkshire culture for years. The core principles, finding great companies with competitive advantages at fair prices, that's likely baked in. Abel might bring his own style, sure, but the foundation probably remains solid.
Okay, reason 5. A mountain of cash. This number is kind of staggering. What was it, $348 billion?
Yeah, about $348 billion in cash equivalents, and short-term treasuries at the end of Q1 2025. Their biggest cash pile ever.
Wow, what's the significance of having that much cash sitting around?
It's all about potential, isn't it? It's massive financial firepower. If market valuations get more attractive, or if a really great deal comes along.
They can pounce.
Exactly. They can make huge investments in those wonderful companies at a fair price. Buffett always talks about it's a major strategic plus.
Like dry powder, waiting for the right moment. That much cash could really drive future growth, couldn't it? Even post-Buffett as CEO.
Absolutely. It gives them incredible flexibility.
Any speculation on what they might buy? With Abel's background, maybe more in energy?
Could be. Energy, infrastructure.
Yeah.
Maybe tech, where they've dipped their toes more recently. But the key will be finding things that fit that long-term value mold. That $348 billion gives them plenty of options to be patient.
Okay, reason 6. A continued track record of aligning with shareholder interests. This feels very Buffett.
Very Buffett, yeah. He's always hammered that home. The article seems confident Abel gets it too.
They mention Abel taking over the annual shareholder letters.
Yeah, that's seen as a signal. Those letters are legendary, right? More than just reports.
Oh, definitely. They're insights into the whole philosophy.
So the expectation is Abel will continue that tradition, keeping that direct communication channel open with the owners of the business.
And why should that matter to you if you own the stock, beyond just curiosity?
It signals transparency, accountability. The letters explain the why behind decisions, the long-term game plan. Continuing them suggests that focus on the shareholders, the owners, remains paramount.
Right, keeping everyone aligned. Okay, last one, reason 7. Buffett plans to stay involved. So he's stepping down as CEO, but not managing.
Exactly. That's got to be reassuring for many. He said he'd still hang around and might be useful in a few cases.
But Abel has the final say.
Abel has the final say, yes.
Right.
But maybe most importantly, the article notes Buffett isn't planning to sell his Berkshire stock.
Putting his money where his mouth is still.
Completely. He's staying invested, literally. His presence, even advisory, offers huge experience, and his stake keeps his interests aligned with everyone else's.
Good point. The article also just throws in the market cap around $1.2 trillion, just to remind us of the scale here.
Yeah, $1.2 trillion. That's the total market value of the company. It just underscores how massive Berkshire Hathaway is in the grand scheme of things.
So wrapping up the Motley Fool's view, Buffett steps down, yes, but they argue Berkshire remains a strong long-term bet because it's diverse, it's stable.
It has a solid succession plan with Abel. The investment philosophy is expected to endure.
Plus that mountain of cash, the focus on shareholders continuing.
And Buffett himself sticking around, still invested. They paint a picture of a company built to last, with strong foundations and a path forward.
It does make you think, though. With that ETF-like diversification and the $348 billion cash hoard, what could they do under Abel? What kind of big moves or new areas might really define Berkshire's next chapter? That seems like the really interesting question for the future.
That's a great point for you to ponder. We've really just touched on the Motley Fool's analysis here. You can definitely find the full article if you want to go deeper.
And reading those Berkshire annual letters themselves is always worthwhile.
Absolutely. They give you that firsthand perspective on the strategy and the thinking right from the source. Really valuable stuff.